Hello and welcome to Module 2 of the Technical Analysis Masterclass, Charting Techniques. In isolation, most trading tools and methods rarely perform as expected without the external confirmation of other elements or indicators. Support and resistance are one of those tools that work independently of other indicators very successfully. In fact, such is the power of support and resistance that many trading strategies are built around them with very minimal external confirmations used to verify trading opportunities. In this lesson, you will learn how to identify and trade horizontal support, how to identify and trade horizontal resistance, how support and resistance can work together, and how to identify and trade role reversal zones. Horizontal support forms because of a buildup of demand, also known as a buyer level, at a certain price. Conversely, horizontal resistance forms because of a buildup of supply, also known as a seller level. In trading terms, an area of support is a zone where price comes down and touches the same area a number of times and fails to go lower. Price then moves in an upward direction before coming down and trying to break lower at the same level. Two touches of the same area gives confirmation that the level is strong and may provide further support into the future. The image that we can see on the screen shows a horizontal green line that is labeled support, and you can see how price has come down a number of times and bounced off it. When we talk about support and resistance in trading terms, they are considered static, meaning that the levels don't change and are always horizontal. Dynamic support and resistance does exist, but we will talk about that later in the section. Support and resistance can be found in all time frames, but it is the ability to use support and resistance in the right time frame relative to your trading plan that is key to using it most effectively. As an example, if you have a support line that is visible on a weekly chart with multiple touches over a long period of time, this support will be very relevant in all time frames below it. A support line that is only visible on a 15-minute chart, although important for that particular time frame and the ones below it, will not be so significant on a 4-hour or a daily chart. Support and resistance levels are also enhanced when they coincide with a key price point, such as round numbers, which often have psychological significance, which adds further strength to the level. For instance, if you have a support line drawn similar to the image on the screen, and the horizontal line happens to be at a key price point, such as a round number like the 120 level on the Euro-USD currency pair, you can expect the support level to be even more significant. The chart that we can see on the screen is an example of how support looks in the real market, and how price interacts with the horizontal support line. Once you have the initial two touches, it is reasonable to expect that this is a valid support line, as price has attempted to go higher, failed, and retreated to the same zone. You can now be confident in the future that if price retraces here again, it should be met with a considerable amount of support to stop it from going lower, as it does in the example on the screen. This zone provided significant support, and you can see that the price tested this level several times before finally pushing up to make new highs. Let's now look at horizontal resistance. As the name suggests, resistance is the opposite of support, and can be found above price. The example on the screen shows a horizontal red line labeled resistance, and you can see how price has pushed up a number of times, failing to make a new high and bouncing down off that level. This type of resistance zone is considered static resistance, as it does not change or move when price does. Once price pushes up and touches the same zone a number of times and fails to break through, it provides some confirmation that the level is strong, and may provide further resistance into the future. The chart that we can see on the screen is an example of how resistance looks in the real market, and how price interacts with the horizontal resistance line. Once you see the initial two touches, it is reasonable to expect that this is a valid resistance line, as price has attempted to go lower, failed, and retraced to the same zone. You can now be confident into the future that if price retraces here again, it should be met with a considerable amount of resistance to stop it from going higher, as it does in the example on the screen. This zone provided significant resistance, and you can see that price tested this level several times before finally pushing down to make new lows. Let's now see how support and resistance can work together. When support and resistance lines are seen close together, as they are in the example on the screen, they often work as short-term targets for price. So when price bounces off the top end resistance, it advances quite quickly to the previous support zone. This is also referred to as a channel, but we will talk about that in more depth later in the module. Now this happens often in many time frames, so keep in mind that when you are placing your trades based on support and resistance, if you place a buy trade at a support zone, a good price point to consider taking profits is a previous resistance zone. The opposite is true for short positions, where a good price point to take profit is the previous support zone. Now let's look at role reversals. In trading terms, a role reversal occurs in an uptrend when an area of resistance is broken and the price returns to the same level after moving higher, and finds support at the very area that was resistance before the break. Role reversal is not a new concept, but not many traders utilize the power of role reversal to its full potential, especially in longer term trends. Role reversal zones are important because they signify a previous level of supply and demand congestion. In an uptrending market, previous supply zones tend to become new demand zones, and previous demand zones can become new supply zones. It is the previous supply and demand congestion that makes these levels significant, thereby often reversing their roles. The dynamics of role reversals are straightforward, and in the example on the screen, you can see that the price has trouble breaking through the resistance zone marked in red, and when it eventually did and went through to make a new high, it retraced all the way back to the same level marked in green. What was a resistance is now new support. In normal trading, you would normally have to wait for at least two touches of a zone before you can expect it to be a support level and draw a horizontal line. But when price pulls back to an area of recent resistance, this is not the case, and any retrace to this zone would be expected to provide support on the first touch. In many ways, this area is even stronger than the standard level of support in an uptrend because of how price reacted to this area prior to breaking through. The very fact that the zone provided significant resistance recently adds to the strength of the support the zone may now provide. Role reversal also works the opposite way in a downtrend, where an area that was originally support becomes resistance once it breaks through, as we can see in the example on the screen. When price breaks through the initial support, it makes a new low, and pulls up to the same area it had trouble breaking through earlier. Again, in normal trading conditions, you would have to wait for at least two touches of a zone before you could expect it to be a resistance level and draw a horizontal line. But when price pulls back to an area that provided recent support, the level would be expected to provide resistance on the first touch. An added benefit to trading a role reversal area is that you will always be trading in the direction of the trend. This is because there would have to be a series of higher highs or lower lows for a role reversal area to appear, making role reversals a great entry point when combined with other technical signals. Let's now look at role reversal zones in action. The image that we can see on the screen is a good example of what role reversals look like on an actual chart, and how you can go about interpreting them. You can see that price is in a sideways motion, hitting the top of the resistance zone marked in red on 4 occasions, where each of the touches only lasted 2 periods before the market was rejected sharply to the previous lows. When price finally broke through the level, it extended up aggressively before pulling back to the same area marked in green, which remained a support base for a considerable amount of time. The example that we can now see on the screen shows a role reversal in action, this time in a downtrend. You can see that price is clearly trending down, finding support in the areas highlighted in green, before breaking through, forming a new low, and pushing up to retest the level marked in red. The importance of support and resistance zones and the role reversal of these zones cannot be understated, and many successful trading strategies can be built around this concept alone when these areas are traded correctly. In this lesson, we've learned how to identify and trade horizontal support zones. We learned how to identify and trade horizontal resistance zones. We learned how support and resistance can work together. And finally, we learned how to identify and trade support and resistance role reversal zones. This concludes section 1 of charting techniques. In Section 2, we take a look at trend lines and how they can help confirm the strength of market trends. Trend lines are one of the most objective trading tools, and this section teaches you the skills to validate quality trend lines in real time.